Hello and welcome to the another class of your chapter 5. So till now we have studied what? We have studied types of business transaction and their generality. Then we have studied petty cash transaction. Now today we need to study about the sales tax. So today we need to study what is sales tax and how the journal entry and recording of transaction which are related to sales tax are done in the books of account. So before starting what is sales tax, let's understand what is the tax structure. So tax is divided into two categories. First one is direct tax. Second category is indirect tax. So first category of tax is a direct tax. Second category is a indirect tax. What is direct tax? So direct tax is charged or levied on profit, whereas indirect tax is charged on sale of goods or service. Okay, and why direct tax is a direct tax? Because it is paid by the person or organization who earns the profit. Okay, that's why it is called as direct tax, because if I am earning the profit then I will pay the tax. So it is direct tax, it is charged on me and taken out from me only, so it is direct tax. But when it comes to indirect tax, it is paid by the person who purchases the goods or service. Okay, and here I am talking about paid, I am talking about thing that is paid. So direct tax is a tax which is paid by the person who wants the profit, but indirect tax is a tax which is paid by the person who buys the goods or services. Okay, so there is it called as indirect tax, because the person who is paying the tax is not the one who is selling the goods. Suppose if I sell the goods to you, if I sell the goods to you, so I will take tax money from you and then pay it to government. So tax is levied on me, tax is levied on me, so it is my duty to deposit the indirect tax to the government. But who will pay for it? You will pay for it, hence it becomes indirect tax, because I am paying to the government but I am taking the money from you, hence it is called as indirect tax. Indirect tax is also of a two types. First one is sales tax and another one is custom tax of custom duties. Okay, so what is the structure of tax? Tax is divided into two categories, direct tax and indirect tax. Then indirect tax is further divided into two categories, sales tax and custom tax. And today we need to study what is sales tax. Today we need to study what is sales tax. Okay, so now let's focus on the sales tax. Now focus on the topic of sales tax. So, sale tax is levied on sale and purchase of product. Okay, it is levied on purchase of goods or service. It is also levied on sale of goods or service. So, sale tax is levied on purchase of goods or service and sale of goods and service. Okay, and if I ask you what is trading, if I ask you what is trading. So trading is a simple activity of purchasing and selling of goods or services. So what do you do first? You purchase goods or service. Then what do? You add some margin or profit then you sell the goods or services. This is the trading activity. What you do in trading? You purchase certain goods or service, then you add some of your margin of profit which you want to earn, then sell it to the ultimate customer. This is trading, and this is same thing which happens in the sale tax. There are sale tax which is levied on two things: first on purchase of goods or services, and then on sale of goods and services. Okay. So whatever the tax which is levied on the purchase of goods and services are known as input tax. So whatever tax which is charged on the purchase of goods or services is known as input tax, and whatever the tax which is charged on the sale of goods or services is known as output tax, is known as output tax. So suppose if I purchase goods from my supplier, so he will charge tax and take the money of tax money from me. So it is indirect tax, hence I am paying the tax money. So it is the input tax because I have incurred this tax amount on the purchase of goods and services, hence it is input tax. Okay. And input tax is a asset. What is input tax? Input tax is a asset. Okay. Which is paid by me to the person, paid by me to the person from whom I have made the purchase, from whom I have made the purchase, and you can also call it as a supplier. So it is paid by me to whom? To supplier from which I have purchased the goods, and then that supplier will deposit the tax to the government or authorities. So what is the procedure? First, if I have purchased the goods, so I will give tax money to him, and then he will give the tax money to the government or authority. Hence it is indirect tax. Tax is levied on him, my supplier, because he is selling the goods. So tax is levied on him, but he will take that tax money from me. So ultimately I am going to cover or going to pay for the tax amount. Hence it is known as indirect tax because levied on him, paid by me to the government. So this is input tax. And when it comes to output tax, so output tax is my liability. The output tax is my liability, and it is paid by the customer. It is paid by the customer to whom I have sold the product, that is goods or services. Okay, so it is paid by the customer to whom I have sold the product, then I will deposit the tax amount with the government or authorities. Okay, so if I have sold goods to you, so you will pay the tax money to me, and then I will pay that tax money to the government. So tax is levied on me because I am selling the goods or services, but I will take that tax money from you. Hence it is a indirect tax because you will pay for the tax to me, and then I will pay it to the government. Duty is to pay government is by me. It is my duty to pay to the government, but I will take that money from you. Hence it is a indirect tax. Okay. So in context of sale tax, there are two types of tax. First one is input tax, second one is output tax. Input tax is charged on the purchase of goods and services, whereas output tax is charged on the sale of goods and services. What is input tax? Input tax is a asset. Why it is a asset? Because it is paid by me for the purchase of goods or services, and I have paid it to the supplier, then supplier will pay it to the government. But when it comes to output tax, what is output tax? Output tax is the liability, because that customer to whom I have sold the goods or services will pay the tax to me, and then I will pay tax to the government. So it is my liability to pay to the government, hence it is my liability, or hence it is known as output tax. Okay, so this is the two concept, that is input tax and output tax. Okay, now let's understand with the easy example. Okay, suppose I have purchased goods of dollar 1000, okay, excluding the sales tax at the rate of 10%. I have purchased goods of value 1000, excluding the sales tax of 10%. Then I have added $200 of profit on the cost of goods. Then I have added $200 as my profit margin on the cost of goods. Then sold it to customer, and then sold it to customer. Okay, now here also sale taxes at a rate of 10%. Okay, so this is the example where I have purchased goods of $1000, excluding the sale tax, and then I have added $200 as my profit margin, and then sold it to the customer. Okay, and then sold it to the customer, and still there is a sale tax of 10%. Still there is a sale tax of 10%. Okay, now I have to make the working. So when it comes to purchase, okay, so I have made the purchase of dollar 1000. I have made the purchase of dollar 1000, on which tax is charged at a rate of 10%, on which sale tax is charged at a rate of 10%, that is equals to $100. That is equals to $100. Okay, so what is the total amount? The total amount is $1100. The total amount is $1100. Now let's assume what happens in this picture. Okay, so I have purchased goods of $1000, on which 10% is the sale tax. So 100 rupees is the sale tax, and total is $1100. So I will pay $1100 to my supplier. I will pay $1100 to my supplier. Okay, let's understand what will happen. I will pay $1100 to my supplier. Then the supplier will pay $100 to the government. Then supplier will pay $100 to the government. Okay, so supplier has received $1100 from me, and then he has paid $100 to the government. So what is left with him? $1000. What left with him? $1000. And what government has got? Government has got $100, and I have paid $1100. Okay, so this amount is known as net amount. This amount is known as net amount, whereas this tax amount is known as sale tax. This tax amount is known as sale tax amount, and sum of both is known as gross amount, and sum of both is known as gross amount. So whenever you purchase any goods or service, the tax will be charged on the net amount. The tax will be charged on the net amount, and after charging tax, what the amount you get is the gross amount. Okay, so this is regarding the purchase. This is regarding the purchase. Okay, where you have purchased $1,000 of goods on which 10% tax is charged. So you have ended up paying $1,100 to the supplier and he has paid $100 to the government. Okay, so this is your purchase. Okay, now comes to the this example only where this is the second part, where is there is a second part. Okay, so now you have purchased goods of value $1,000, then you have added the profit margin, then you have added the profit margin of $200. Okay, so what is the now amount? Because you have made purchase of $1,000 or $1,100 or $1,100. You have made the purchase of $1,000 and not of $1,100 because $100 is the tax amount and not the purchase amount. Okay, so you have made the purchase of $1,000 on which you have added the margin of $200 which result in $1,200, So this is what you have done. Now you are selling the goods on $1,200. So this is your selling price. This is your selling price, or you can say the sale value, whereas this 1100 is your purchasing price, or you can say purchase value, So you have purchased goods of $1,000 where you have added $200 as the profit margin. So now you are selling the goods on $1,200. So now comes to sale. Okay, so now we are going to talk about sale. So you are selling the goods on the value of $1,200. You are selling goods on the value of $1,200 on which sale tax is to be charged. At a rate of 10%. So amount becomes $120. Okay, 1200 10% of 1200 is $120, and the total amount becomes $1,320. The total amount becomes $1,320. Now this is again the net amount. This is your sale tax amount, and this is your gross amount. Okay, so you now have the selling price of $1,200 where you are going to charge 10% of the sale tax, and there is the gross amount which you need to take from the customer. Okay, so now what happens? I will take $13-20 from customer, then will pay $120 as sales tax to the government. So what I will do, I will take $13-20 from customer and then pay $120 of the sale tax to the government. So I am going to do this. So if you look at the transaction, what is the first transaction? That I have paid the purchase of $1,000 on which $100 of sale tax is there, and I have ended up paying $1,100 to the supplier. Then I have added $200 of profit margin on the sale amount. Sale amount is $1,000, and then I am ending up selling the $1,200 of my selling price, in which again the sale tax at the rate of 10% has been charged, and I will take from customer $13-20 on which I will pay sale tax of $120 to the government. So this is the flow of transaction. Okay, this green one is what? This green one is your input tax. This green one is your input tax, whereas this red one is your output tax. This red one is your output tax. So now you have input tax and now you have output tax. Okay. Now I need to make you explain something. First, how much of tax has been charged on this? $100. Okay, now first, what was the amount that is charged as a sale tax on this? $100. Then again, if you look at here, again $120 has been charged. Okay, first what happens? First, $100 has been charged when you have purchased the goods. Now again, $120 has been charged when you are selling the goods. So if you make the total, what happens? The tax becomes $220. The tax becomes $220, where you have made the purchase at a rate of $1,000 and now you are making the sale at a rate of $1,200. So what happens? The government will earn $220 on $1,200 of sale, which is more than 10%, which is more than 10%, that is more than the tax rate, which is more than the tax rate. So this becomes what? This becomes double taxation. This becomes the problem, that is double taxation. Hence, in order to remove this problem, what the new concept occurs is the concept of input tax and output tax. The new concept occurs, which is the concept of input tax and output tax. Okay, so now what is input tax and what is output tax? Let's understand. Suppose in this illustration only, you have the input tax of $100 and you also have the output tax of $120. Okay, so this is the input tax which you have already paid to the supplier, which he has already deposited with the government. So government has already got $100. Now again, when you have sold the goods, you are taking 120 as the sale tax. So now if you deposit 120 again, the government will get $100 plus $120, that is $220, which is more than the tax rate, which is the more than the tax rate, and hence it becomes a double taxation. So you don't need to pay the entire sale tax amount when you have already paid the input tax amount. So if I ask you, what is your input tax? So input tax is your asset. And what is output tax? So output tax is your liability. Okay. And if I ask you, what is your net liability? So then you can call it that I have the total liability of, you have the total liability of $120 and you have the total asset of $100. So your net liability becomes $20. So your net tax liability becomes $20. So what you will do? You will pay $20. You pay $20 to the government. You will pay $20 to the government. Okay, so what happens? First, government has got $100 when you have purchased the product. Now you will pay $20, and what government will get? Government will get $120, which is $120 divided by $1,200, that is selling price, becomes 10%. So now tax has been correctly charged. Now tax has been correctly charged. There is no problem of double taxation. Okay, so what I'm trying to explain you is that the sale tax has two categories. First one is input tax, second one is output tax. So every time you make purchase, you end up paying the tax, becomes your input tax, and every time you make the sale, the tax which is going to be paid by the customer to you and which you are going to pay to the government becomes output tax. So input tax is the asset, output tax is the liability, and net of both, and net of both is your net tax liability. liability, and net of both is the your net tax liability. Okay, so now what? So if input tax is less than your output tax, if input tax is less than your output tax, it will become your tax liability, whereas if input tax is more than the output tax, it will become the tax refund. It will become the tax refund, because if input tax is less than the output tax, so you need to pay tax to the government, and if input tax is more than the output tax, then you need to take refund from the government that you have deposited more tax to the government, which is more than your liability. Okay, so this is the concept of sale tax, where sale tax is further categorized into two parts. First one is input tax, second one is output tax. So input tax is the asset, output tax is the liability. Input tax is charged on the purchase of goods and services, whereas output tax is charged on the sale of goods and services, and net of both is the your tax liability. So if input tax is less than the output tax, it is your tax liability, that is you need to pay to the government. And if input tax is more than the output tax, then it is your tax refund from the government. And this is the example where we have use the concept of both the taxes, input tax and output tax. Okay, so you have made the purchase of $1,000, you have made the purchase of $1,000, on which 10% of the tax has been charged, that becomes $1,100. Okay, so now you will pay $1,100 to the supplier from whom you have purchased the goods, and then he will pay $100 to the government and will remain $1,000 with him. So it is input tax for you. Input tax of how much? Input tax of $100. Okay, now what happens? You added margin of $200. You added margin of $200. So your selling price becomes 1200. Your selling price becomes 1200. Okay, your selling price becomes 1200. Now you are selling goods on $1200. So again sale tax will charge on the sale. So your total price becomes 1320. Your total price becomes 1320. So what you will take? You will do take $1320 from the customer and then pay $120 to the government as output tax. So this is your output tax, that is $120. And if we do net of both, if we do net of both, okay, so we will see that there is the input tax of $100 and there is the output tax of $120. So what is your net liability? Your net liability remain $20. This is your net liability, that is $20, because your input tax is lower than your output tax. Your input tax that is $100 is lower than your output tax of $120. So your net liability becomes $20. Okay, so this is the concept of sale tax. Bonus point which I need to tell you is that if you look on the margin, so what margin you have added? You have added $200 of margin. You have added $200 of margin, and if you look at the net tax liability, that is $20 on the margin which you have added. That percentage will be 10%. That is equals to the sale tax percentage. So sale tax is charged on the selling price, but every time you make the margin, it is charged on that differential amount. So you have already paid tax on $1,000, that is your input tax, and now you are selling goods again on $1,200. So net liability will be on the net margin which you have added on the cost of goods, that is $20. That is 10% of $200, which is your margin. Okay, so this is the concept of sale tax. I am giving you 5 minutes to read all this example, then we will go for the notes. Okay, So I'm putting screen on full screen mode so that you can read it. Okay. Okay, so I hope you are done reading with this, and with this all these examples which I have given. Now comes to the notes of this chapter. Okay, so sales tax. So what is sales tax? Sales tax is an indirect tax. Sales tax is an indirect tax imposed by the tax authorities or government. Sales tax is charged as percentage on sales. So sales tax is charged on the percentage of sale, like 10% in a example. Okay. Then sale tax is categorized into two parts. Sale tax is categorized into two parts. First one is input tax, second one is output tax. Now, what is input tax? So it is the sale tax paid on purchase of goods or services. So what is input tax? Input tax is the sale tax which you have paid on the purchase of goods or services. Okay. So whenever you see, you have to look on the point of view of yourself. If you are purchasing the goods, so it is input tax for you. If you are selling the goods, then it is output tax for you. If you are purchasing the goods, so it is input tax for you because you are purchasing, and it will be sale tax for the supplier who is selling goods to you. And in the same way, if you are selling goods to someone, if you are selling goods to your customer, so it will be output tax for you but input tax for him who is purchasing the goods. Okay, so you have to look on the point of view of yourself. So input tax is the sale tax paid on the purchase of goods or services, and it is the current asset. It is the current asset. Whereas output tax is the sale tax charged on sale of goods or services. So output tax is the sale tax charged on sale of goods or services. It is the current liability. It is the current liability. So input tax is your current asset, output tax is your current liability. Okay. Now, if your input tax minus output tax is positive. Suppose if your input tax is more than the output tax, if your input tax is more than the output tax, so it becomes your tax refundable, that you need to take money from government because you have paid excess tax to the government. Whereas if the output tax is more than the input tax, if the output tax is more than the input tax, so the differential amount is the tax payable, which is your liability, because now you have to pay remaining amount, that is the difference amount, that is output tax minus input tax difference amount, is the amount which you need to pay to the government as the net tax liability. Hence it is your tax payable, which is current liability. Okay, so if input tax is more than the output tax, it becomes tax refund. If output tax is more than the input tax, it becomes the tax penalty, or tax payable. Okay, or tax liability. Now comes three element: net amount, sale tax, and gross amount. So what is net amount? The sale or purchase price before sale tax. So any price which is before charging the sale tax is your net amount. Then comes sale tax. So it is the percentage of tax charged on the net amount. So sale tax will be charged on the net amount. Sale tax will be charged on the net amount, and net amount plus sale tax is equals to the gross amount. Net amount plus sale tax is equals to the gross amount, that is sale or purchase price after the sale tax. Sale or purchase price after the sale tax is the gross amount. That is, if net amount is 100%, if net amount is 100% and sale tax is the percentage which is charged on the net amount, hence gross amount becomes 100%, that is net amount plus sale tax is equals to gross amount. So gross amount is equals to 100% plus, that is net amount plus sale of tax. Okay, plus sale tax which is charged on the net amount. So this is the very basic concept of the sale tax. That sale tax is divided into two part: input and output tax. Whenever you purchase goods or services, it is your input tax. Whenever you sell goods or services, it is your output tax. Okay, input tax is the current asset, output tax is the current liability. Okay, and difference between both is either your tax payable or tax refundable from the government. The three elements are net amount, sale tax, or gross amount. Okay. Now this is the very basic. Now comes to the accounting of sale tax. Now comes to the accounting of sale tax. Okay, so before starting for the accounting of sale tax, you need to keep two things in your mind. Okay, first one is sale will result in output tax, whereas purchase will result in input tax. Sale will result in output tax, purchase will result in input tax. Okay, and difference of both is the net liability, and difference of both is the net liability. Now, based on this principle, we need to understand what will happen in case of sale, both sales, cash sales and credit sales. Then we need to also understand what will happen in case of sale return. Then we need to understand entries for in case of purchases, that will be of both type, cash purchase and credit purchase. Okay, then you have to also look for the entries regarding purchase return, and after purchase return you have to look for tax payment entry. You have to look for tax payment entry. Okay, so these are the entries which you need to understand in the context of sale tax. We have already seen how entries are done for cash sale, credit sale, sale return, cash purchase, credit purchase and purchase return, then receipt and payment, everything in our first lecture of this chapter. Okay, so we have already seen the entry. Now you only have to add tax element on those entry. Now you have to make tax element on those entry. Okay, so suppose if I am selling $1,200 of goods to Mr. Suppose, look, let's take very basic example. Okay, suppose if I am selling $1,000 of goods to for cash, and sale tax is at the rate of 10%. So what will be my journal entry? My journal entry will be that now it is the sale tax. Now so there are three elements. First element is sale, second element is sales tax, third element is cash. Okay, now what is sale? So sale is the income. Sale is the income. And what is sale tax? So this sale tax is charged on the sale. So every time the tax is charged on the sale, it is the output tax. So it is your liability. Output tax is your liability. And what is cash? Cash is the asset. Cash is the asset. Okay, so now if this is the income, so what rule will apply? The nominal account rule will apply, that is credit all the income and gains. Okay, so this is the rule which will going to be applied. Then comes liability. Then comes liability. So what is liability? Liability deals with real account. So debit what comes in, credit was goes out. So this is you are incurring the liability. So you will credit what goes out. Okay. Now comes the cash element. Okay, so you are receiving cash against the sale. So debit what comes in. Rule will apply, that is debit what comes in. And hence based on these rules, what will be my entry? First I will do debit. So cash account debit to sale account, because sale amount is going to be credited, and then to sale tax again credited to sales tax account. Okay, your sale was of $1,200. Your sale tax at the rate of 10% is $120, and your debit amount will be $1,320. So this is the amount which is going to be charged on your journal entry. Okay, so journal entries are very simple, as we have already discussed in detail. You just have to make the tax element the part of journal entry. You need to make tax element as a part of journal entry. And just remember, when there is a sale, just remember, when there is a sale, so it is your output tax, and when it is the purchase, it is your input tax. And output tax is the liability, input tax is the asset. Okay, so this is the very basic concept. Okay, so by applying this concept, you will be able to solve all the journal entries. Okay, so when it comes to cash sales, the entry will be cash account debit to sale tax to sales. So cash amount will be of gross amount, and sale tax will amount will be of sale tax amount, and sales will be of net amount. Okay, so just a simple journal entry with the additional element of sale tax. When it comes to credit sale, so credit sale will be trade receivable account debit to sale tax to sale. Trade receivable will be the gross amount, sale tax will be the sale tax amount, and sales will be of net amount. Okay, so this is very simple, as we have already studied in types of business transaction. Then comes sales return. So now goods are sent back to you because of defected or being faulty. So sales return account debit, again you are reversing the sales. So what you will do, you will debit the sale tax liability. Because you are cancelling out the sale. So sale tax liability will be debited to trade receivable, or the entry will be sales account debit, sale tax account debit to trade receivable. Okay, this is just the same entry with the additional element of sales tax. Then when it comes to cash purchase, so purchase will be debited, and now purchase is you are doing the purchase. So what will happen? It will generate a input tax. So input tax is your asset. So sale tax account debited because it is the asset to cash or bank. So purchase will be of net amount, sale tax will be of sale tax amount, and trade or cash amount will be of gross amount, that is including net amount and sale tax. Okay, then comes credit purchase, that is same purchase account debit, sale tax account debit to trade payable, and purchase will be of net amount, sale tax will be of sale tax amount, and trade payable will be of gross amount. Okay, so these are the all the same entries which we have already studied in the first class of this chapter, where we have studied types of business transaction. Only one element has been added in all the entries, which is the sales tax. Okay, which is the sales tax. Then comes purchase return. So again, trade payable account debited because you are sending goods back to the trade payable. Trade payable account debited to sale tax asset. Now you are reducing the asset because you have cancelling out the purchase. You sale tax account credited to reduce the asset to purchase return. Or entry will be trade payable account debit to sale tax asset to purchase account, where trade payable will be of gross amount, sale tax will be of sale tax amount, and purchase return will be of net amount. Okay, so this is the entry. So till now what we have studied: entry for cash sales, credit sale, sale return, then cash purchase, credit purchase, and purchase return. Now after doing sale, purchase, everything, what will incur? Either there will be a tax payable or tax refundable. So entry for payment of tax will be sale tax account debited, because you are reducing the liability, so you are debiting the liability and paying the asset, so asset will be credited. So sale tax account debited to cash or bank in case of payment of tax. And when there is the tax refund from government, so you will receive the amount. So cash or bank account debited to sale tax asset, because you are cancelling out the asset, you are getting the money against it. So cash or bank account debit to sale tax asset in case of refund from government. Okay, so these are the journal entry in context of sale tax. So with this, we have completed our one of the most important topic, that is sales tax. Okay, these all concepts will be used in the chapter where we need to prepare financial statement. Okay, so here we have to make our base so strong that we are not going to do any mistake when it comes to the chapter preparation of financial statement. Okay, so we are done with the sales tax topics. If this video goes on YouTube, and if you want these notes, or either if you want these board notes, then you can comment on the below of the video, and I will provide you the free notes and free board notes on my Telegram or WhatsApp community. Okay, so if you want all these notes, you can just comment it and I will give you the link for the same. Okay, so by this we are done with the sale text topics. Okay, so this is all for this class. We will see you in the next class. Thank you.